Welcome back to the Scholar Wealth Podcast. Today's episode is about decision-making when the numbers say you're fine, but the choices still feel a little bit more complicated. We'll start with a question on charitable giving, specifically how to evaluate where to give when you want to make the most impact. Then we'll walk through a tax planning situation around wash sale rules. This can come up regularly for investors with multiple accounts, similar holdings, and a lot of automatic activity happening in the background. And to close out the episode, I'm joined by Mike Blake for a practical conversation on business valuation. We'll talk about how valuations are actually determined, where people tend to misunderstand the numbers, and why valuation matters far beyond a transaction. So let's go ahead and get started with our first question. Our financial plan shows we can give about $100,000 a year to charity, but I don't have any personal connection to any organizations. How do I figure out where that money will actually make a meaningful impact? So this one typically, and it may not be the case here, but we typically see this a lot whenever there's a tax benefit of the charitable giving and your CPA says, what would save you some money this year is if you just gave $100,000 to charity and then come back to us and we run all these models and say, yes, you can give $100,000 to charity every single year and it doesn't impact your plan and there'd be some tax benefits. And then the big question hits, well, where do I actually give the money to? And there's easy answers to this and there's a little bit more difficult answers to this. I equate charitable giving sort of to a lot like real estate investing where it's like there are easy ways to go. You just don't get a lot of the benefits. And then there are a little bit more difficult ways to go where more of the benefits show up. So you could go give just a $100,000 check every year to the American Red Cross. That wouldn't be a problem. It's going to be very easy for you to do and you're going to be done. Wash your hands of it. You did your charitable giving for the year. That being said, that's the easy way, but the impact of that likely is not going to be as large as if you were to give to smaller organizations, especially at this level, or local organizations. That's when you're going to start seeing a bigger ROI on the type of charitable benefit that you end up seeing. And that's not a knock against these bigger charitable organizations or anything. There's some great missions out there. But whenever you start to lengthen the distance between you writing the check and the actual good that is done with the check that you wrote, there's a lot of room for disappearing funds to administrative costs, to overhead, to varying missions that may not align with what you're actually hoping to get out of it. Where whenever you're giving a little bit more local, you tend to have a lot more oversight of where that money is going. And you're going to write a check and it's going to do that exact thing. You have a lot more volunteering. Now there's downsides to that as well. And we can talk about that today. But if you look at a local organization, what I'd recommend in your case, because $100,000 is a significant amount of money, especially at a local level. You can go to a local organization, a local charitable organization, a local humane society, or a little league field, and you put $20,000, $30,000 down, and you are completely changing that entire organization and possibly their future. And that's just $30,000 in 1 year, not taking into account the fact that you're looking at $100,000 every single year, which brings up the next problem that you need to look at this a, as a way for you to start a multi-year commitment with 1 year commitments. In other words, you don't know where you want to put the money now. No issue there. There's no rule that says you have to go right now and go spend $100,000 just at one place. You can start dividing it up. I guarantee you that for all those local organizations that are out there fighting for $1,000 or $2,000 a piece, if you were to find 5 to 10 around your local area and go in and say you would like to make a $10,000 to $20,000 donation for that year, and then start interviewing them on what they're going to do with it. And these are fun conversations. We sit in these conversations with clients all the time. These are great. They're happy conversations. They have great ideas. Everyone has an idea. If you go to any of these organizations, say, how would you spend 20 grand? I guarantee you they have a list of how they would spend $20,000 and what they've been trying to save for. So you basically ask for that presentation. How are they going to use it? Who's running it? Right? That's where we tend to have a little bit of issues around leadership, transparency, accountability on some of these smaller organizations. You're going to have to be a little bit more involved in that process. What you don't want to do is just provide blank checks out and hope that it's done with however you want. Now, some people choose to do that, but usually when you hear about that, that's from relationships that have already been established in the past. In other words, you've been giving to the local humane society. You know the board. You know who's running the different organizations, where their funds are going, what types of campaigns they're running right now. And you've been funding them for years. And then there hits a certain point where you're okay just writing a $50,000, $60,000, $100,000 check for them because you know where it's going to go and who's running it. But to start building up those relationships that you're doing now is a little bit of a fishing exercise. You're going to throw a little bit of money into a lot of different organizations and you're going to see who's going to use it the right way, who does what they're supposed to be doing with it. Where do you get the most impact? And what's going to be most enjoyable for you? One of the great things about charitable giving while you're alive and as opposed to as part of your estate is that you're able to see the benefits of your giving and you're able to provide this level of accountability. You're able to have that access to leadership to talk to them about what goals they should be doing and how you would like to help them achieve those goals together. So it's a great opportunity. I wouldn't take it as a deterrent that you don't have a personal connection to a charity. One times, a lot of people don't have personal connections to a charity. Miraculously, once you start giving money, then you'll have a personal connection to those charities and they'll know you by name as well. So there's no limit to all the different organizations that are out there. That can be overwhelming, but you have to start somewhere, start going to some of these organizations, thinking about what you enjoy, walking around. And a lot of times in your community, you're going to see a lot of these opportunities continue to open the door to you. And now on to our next question. We have about $10 million invested across multiple taxable accounts and try to do tax loss harvesting between similar ETFs, different custodians, and automatic reinvestments happening in the background. I'm thinking we may have accidentally triggered wash sales. How concerned should I be, and what should we be doing differently going forward? So, common issue. It's not generally as big of a problem as people think about until you have to start self reporting things. What I mean by that is your broker will report a lot of the wash sale activity as long as they can see what's going on. It's when they can't see what's going on, then it becomes impossible for them to report any wash sale, which ultimately comes down to you self reporting. So let's take a step back and think about your situation. So, wash sales, to make sure we're all on the same page with it, what will trigger a wash sale is you go in and sell an asset in your account. Let's say you own Ford stock and it drops 10%, you go sell it to capture that loss and you're going to write it off. But then the next day, you go buy Ford stock again. Well, the government looks at that and says, you really didn't sell it. You still own the same amount of Ford you did yesterday, but we were able to allow you to have this loss. So they disallowed that loss. In fact, they really reset your basis on that situation. So that way you aren't able to take the deduction on that loss at that time. So we have a couple things at play. One is the timing aspect. You can't buy identical or substantially identical investments within 30 days. So if I sell Ford stock today at a loss, I'm not going to be able to write that loss off unless I wait 30 days, 31 days until I buy Ford stock again. Now, where the gray area of wash sale rules has really started to take hold is in this idea of substantially identical investments. So the IRS looks at this and says, well, what if Stephan goes and sells a S&P 500 fund from Vanguard, sells it at a loss, and then goes and buys a Schwab S&P 500 fund the next day? Do I have the same investment in my portfolio? There's no rule associated with that other than they can't be substantially identical. Now, my personal opinion, you look at that and I would say those look pretty substantially identical to me when they hold the exact same things in the same funds. But I've heard arguments from people that say, well, those are two different companies. One's Vanguard, one's Schwab. So that alone makes them a little different. And then you have others that say, well, if I sell a S&P 500 fund and I go buy a S&P 1000 fund or a Dow 30 fund, then that's different enough. Now that I can start to buy, you look at something like that, and now you have a completely different set of underlying investments. So your correlation may still be higher, but they're not substantially identical, in my opinion. And this is exactly where the gray area. And you could see we could play this game all day long of trying to see, well, which fund is substantially identical to another fund. And if you look online, you'll see tons of different tax loss harvesting pairs. That's why they exist. It's people have come up and said, if I sell this, you can buy this, and it's different, but it's the same, right? You have this substantially identical scenario. I'm selling the NASDAQ, but I go and buy a S&P 500 growth fund. That's going to be mostly tech. I sell one small cap fund and I go buy another small cap fund. So it's not only individual stocks that can trigger these wash sale rules. It can be ETFs, index funds. The similar exposure is what creates the issue. Now, when people get in trouble with this, a lot of times they didn't even know they have a wash sale issue. I'll get emails and say, "Hey, Stefan, I don't know what happened. I got this alert that I just created a wash sale." And they're worried about it and everything else. And a lot of that comes from dividend reinvestments. This is a common culprit is you have dividends that are automatically being invested. And by doing that, you sell a stock in one fund or you sell one stock, and then dividends get reinvested from either part of that stock or another section of the stock or in a different account. And now you've created a wash sale because you went and bought the same security, even though it was a small amount, you bought that same security within those 30 days. So those automatic reinvestments will come up. That's not as much of a problem if those securities or investments are all held at the same broker, because what'll happen is they'll be able to identify that and say, "Hey, you just rebought Apple stock after you sold it for a loss last week. So that's a wash sale. You're not going to be able to use that. So we changed your basis around." And they'll report that in your 1099 at the end of the year. So that doesn't create as much of an issue. Where it creates an issue is where I have a brokerage account over here that I sell something in, and then I have another brokerage account at a different custodian, and I buy something over there, or I buy something substantially identical to it. And now I have a wash sale that no one knows about except for me. And the risk there is maybe I don't even know that that's occurring if I don't know about these types of rules. So it is really important when you're thinking about rebalancing and tax loss harvesting, especially, that you're not only looking at the tax loss harvesting and wash sale risks for an individual account, but all of your accounts collectively. I'll throw another one at you. The other thing I'd want you to watch if you're going through all this and worried about wash sales, your IRAs get mixed into this as well. Big area where people don't realize. They say, "Well, what does my IRA have anything to do with this? Because I'm dealing with a brokerage account and that's where my losses are. I can't take losses in my IRA." That does not matter. If you go and sell GM stock for a loss over in your brokerage account and then you go buy it in your IRA, that loss is now completely disallowed. So it doesn't even reset your basis. It's gone. You don't get that loss anymore. So it is a major risk. So the common areas where you're asking for what you should be doing differently going forward, I think you're really careful about when you're selling, what you're going to be buying. I would shut off the dividend reinvestment unless you're just really opposed to touching your account throughout the year. Dividend reinvestment ends up causing a bunch of problems, especially when you're doing rebalancing, tax loss harvesting, and you're trying to handle your portfolio, especially with rates where they are now. If your broker has a good cash management system in place where you're automatically investing in a money market, you're not missing out by much by taking that average 1.5, maybe 2% a year in dividends and it being held in cash, earning 3 or 4% while you rebalance it throughout the year. It's not saying that we're never going to reinvest it again. What it does is you just end up with a little bit more of a cash pile at the end of the year that then you go and reinvest. And actually, it can be helpful with rebalancing as well, because dividend reinvestment gives you ideally, or in most cases, roughly similar exposure for dividends, where if you're collecting all those dividends out in cash and then deploying them where you want them to be, you're not going to have to worry about any losses or sales there. The big thing to keep in mind with all of that, so watch the dividend reinvestments. As I mentioned, you want to be careful with custodians, different accounts, including your IRAs. But the big thing to keep in mind is you are ultimately responsible, just like tax and everything else. You have to be the one who's understanding where your wash sale exposure is, whether or not you're investing in substantially identical investments or not. And you have to make that call. Taxes are all self reported. And in this case, you can't rely completely on your broker, especially if you have multiple custodians, as you do in your case. And for today's From the Field interview, we're stepping in the world of business valuation, a topic that can play a major role in planning transactions and ownership decisions. Today, we're joined by Mike Blake, a business appraiser and managing partner of a boutique valuation firm that works with founders and family owned businesses on transactions, equity planning, wealth transfer involving closely held businesses. Mike spends much of his time helping families understand how valuation works in practice, including how ranges are determined, how discounts function, and what holds up under IRS scrutiny, the all important question. So, Mike, welcome to the Scholar Wealth Podcast. To start, why don't you give us your version of your background here and the work you do today?
Well, hi, thanks for having me on. I think you probably did as well as I could have, but I'm a business appraiser, a second generation appraiser, actually, as it turns out. I'm a recovering venture capitalist and investment banker. Unlike a lot of my colleagues, I'm not an accountant. I'm about the worst accountant you'll ever meet in your entire life. I don't even do my own taxes. So as long as we stay away from hardcore tax and gap questions, we'll be fine.
I think both of us would like to avoid the hardcore gap questions as well. So that's completely fine. So you mentioned second generation. So how did you make that shift from investment banking, private equity, and then into business valuation? Was that always something you enjoyed, or that how did that transition happen?
It happened kicking and screaming, and I'll tell you why. Because on the one hand, I enjoyed venture capital, but I wasn't very good at it. It was my first job out of school, and when you're like that, when you get into venture capital, you meet all these entrepreneurs, and you're young, you just want to fund everybody, and that does two things: it makes you popular, and it makes you poor. And so that's not a great combination necessarily. Investment banking, I was really, frankly, I was good at, but the problem with investment banking is that the client becomes the enemy. And the reason for that is that because I only make money if the client sells, once I am engaged to that client, my goal then is to convince the client to sell. At least that's the way the monetary incentives are set up. And I know a lot of investment bankers are now screaming, saying, I don't do that, you SOB, and we're not crooks. And that's right, you're not. Most are not. There's some that are. But I could never really get comfortable with that incentive structure. So I decided that I'm a better referee than I am an advocate. Why kicking and screaming? Well, and you can, if you want, you can just attribute this to a proud son. But my father ran the valuation practice for Ernst Young North America for about 25 years. And he testified as the sort of the star financial witness in cases like AIG, Enron, the Parmalat bankruptcy, the New England Patriots antitrust suit against the NFL. So my dad was basically the LeBron James of valuation, and I was going to be Bronny. The problem is valuation, it turns out, is the only thing that I'm good at that I can make a decent living at legally. So I wound up being sort of drawn back into that orbit again about 20, 25 years ago.
Perfect. Well, when you're doing that, because there's a difference on valuation, as you said, on the VC side, the banking side. Now, what you're doing now, when people think valuation, the most common thing I hear is that everyone wants the number. And they're like, well, what's it worth, right? What's the number there? Tell us a little bit about what goes into that, because it's not just, as you mentioned, it's not just the ratios and the accounting. What goes into that? What should they be thinking about? What's kind of wrong with that idea of put all this together and might give me one number that encompasses what my business is worth today.
So I think what a lot of people misunderstand about value is that value is not truth. To paraphrase Raiders of the Lost Ark, if you're looking for truth, go take a class in the philosophy department. Valuation is not an element of truth. Valuation is a narrative, it's a story, it's a thesis, it's sort of a gravitational pull towards a particular space and time in the financial plane of existence. Metaphysical here, but valuation is kind of like that. So when we talk about point estimates of value, we're talking about a particular narrative. And one of the things that frustrates a lot of clients and frankly frustrates a lot of practitioners is two practitioners faced with a similar fact set can come up with radically different answers. And part of the reason for that is because again, valuation is not a science. Now it's often referred to as like a mystical art, dark art, and so forth. And I have a somewhat of a sense of humor of that to a certain extent. Like I got this little Gandalf thing that I keep on my desk that sort of reminds me of that reputation. But it's a craft. And it's a craft that combines blending objective data with informed professional judgment. And the synthesis of that is an opinion of value that we call an appraisal, where clients I think are starting to understand and elevate their thinking on this is that the number is important, but why you got that number is at least as important as the number itself. The credibility and the fact that an appraisal properly done is just chock full of all kinds of actionable intelligence that could be used to optimize the value of the subject asset in question.
I agree that one of the biggest things that that I see is that how you tell the story of a business, how it fits into the current landscape, especially when you start dealing with like synergistic partnerships and all of this. Is that up to you, or is that the owner coming to you and they have to tell you that story and then you put a price on that story? I don't know how to describe that in a way that's like, are you on a team or are you truly the referee? Like if somebody looks at you and says, here's my business, and they don't tell you the story, is it your responsibility to come up with a story for them to increase the valuation? Or is it to say, given what you've given me, here's what I think the valuation is?
Yeah, so it's definitely not my responsibility to create the value story for them to try to increase their value, at least not in an instance where I'm an appraiser. Now, there's certain engagements where I'm not acting as an appraiser, but rather I'm acting as an advisor, an advocate, a consultant for the client, in which case I can do that. I can use the levers of value to help my client negotiate the best deal that they can. Because to me, negotiation boils down to two levers. It's one, asymmetry of information, and two, knowing what your walk away point is. And so my role is to at least create equilibrium in terms of asymmetry of information, because many buyers have bought many companies. Most sellers do it once, and there's taking a knife to a gunfight. So I'm there to sort of stand next to them with a gun to make that an even fight. And then the knowledge helps you know what your walk away point is, to know that, because if you're never willing to walk off the car lot, then you're never going to get a very good deal in the car. And that is true with businesses as well. But in most cases, then my job is to be an appraiser, which means to be a referee. And what I tell my clients is this: is it does me no good, does you no good to retain me and tell you something that I don't think is the most robust, credible answer. Because if I kind of send you out there into the marketplace looking for a value that made you happy in the moment that you're talking to me, the market is going to educate you real quick that that was not a particularly reliable, credible value. And then you're going to be very disappointed. Then you're going to come back to me 10 times madder than you would have been than if I'd given you a disappointing value conclusion at the outset. So, I tell all my appraisal clients that you may not like what you hear, but you need to hear my best judgment, because going out into the market with something that's not that is 10 times worse.
When it comes to those value drivers for someone who is walking into this with their knife to a gunfight type of scenario, what are some of the, or are there any of these kind of low hanging fruit that you look at just most founders or most families miss out on when they're looking at value, that if they just had 6 months or a year to make some changes, that would drastically increase the value of the firm?
The cool thing about businesses is that businesses are created and run by human beings, right? Just like you and me. And 95% of business problems or weaknesses are human created, which means that 95% of business problems are human solvable. It's just a matter of frankly, in many cases, it's a matter of the willingness of the client to solve them. So the first issue is customer or client concentration. Anytime you have more than 10% of revenue coming from a client, the market starts to discount your company fairly rapidly. That becomes a significant risk lever. The second is product concentration. Are you a one-trick pony, or do you need to diversify? The third is over-reliance on the owner. As I, the question I ask is, if you went on a safari and you got off the plane, the first thing you did was throw your smartphone into the river, and you came back in 3 months, what is left? And that spectrum is going to be anything from a thriving business on the one end to a smoldering crater on the other. And what is that? Question number four is my favorite question, which I ripped off from Warren Buffett, which is, if you raise your prices by 10%, what happens? And many businesses simply do not charge enough. And they discover that if they have the courage to raise their prices even a little bit, that they all of a sudden make a lot more money. And then fifth is standardized processes. Remarkable how many companies still sort of fly by the seat of their pants. But by simply documenting processes, whether in writing, video, podcasts, smoke signal, cave painting, whatever it is, something, anything, t-shirts, owners can increase the value of their business. And notice all these things, with the exception of pricing, all of these things, none of these things involve like going out and selling more. They all involve de-risking the business, which is the easiest thing you can do to improve value. And if you work the math, it's also the thing you can do that adds the most leverage to the value of the business. A little bit of risk reduction goes a long way towards increasing the value of the business.
And how does that all come into play with, because you mentioned the owner and we have controlled discounts, right? Or non-controlled discounts and liquidity discounts. How does that affect the valuation on the negative side, right? Because what you just gave are all great ways to increase the value, but then you drop the value afterwards, right? You pull everything up and say this is the ideal scenario, and then you put all these discounts on it. Maybe you could talk a little bit about why somebody may want that discount created, because that's another aspect as well, and that's where the IRS part tends to come in. But let you go from there on it.
Yeah, you generally want a low value in a couple of cases. One, because you're gifting or you're preparing for an estate event. So ideally you would like the value of your business or the interest of your business to be low and potentially fall underneath the taxable threshold. You may also want to lower the value of the business because you like to make it easier for the next generation coming up to buy. If you're in the unfortunate case of being in a divorce situation and you're the moneyed spouse, you want your value to be low. So there are all kinds of scenarios in which an owner would like their business value to be low. But that's also something that you can manage. So let's take lack of control discounts, because that's really interesting. One way that you can manage, frankly, and optimize your lack of control discounts is, instead of gifting shares in your company in big chunks, do it in lots of small chunks. Because generally speaking, on a share for share basis, the control discount is going to be larger for a relatively small share of the company than it is for a large share of the company. And you don't have to do the math to understand this. I'll just give you an example that you and everybody listening to this will understand. Would you apply a larger discount to a 49.9% share of a company, or would you give a bigger discount to a 1% share of the company? Right. And you apply a much bigger discount to the 1%, because it's very unlikely you can arrange to have any kind of influence over the company whatsoever. But if you're 49.9 and there are three shareholders and there's a swing vote out there that you can potentially sway to your side and influence company policy. So yeah, a big mistake I see that is often made is many owners say, well, I want this to be simple. I want to do this in one or two big chunks. And so what they do is they gift, 25, 35% chunks. But while they do that, they're not optimizing their tax burden, because they're giving away too large chunks of the company at once. And one thing to keep in mind about how the IRS behaves is, they don't assume they don't assume that separate gifts, even if they're given to the same family member in different gifting events, they do not assume that they're all going to be voting as the same block. You have to appraise them as if they're standalone shares that are owned by independent ownerships. So that's one fairly straightforward way. And lawyers are loving this because they'll make more money, but so be it. That's one way to manage value through optimizing your lack of control discounts.
And how does that play into lack of liquidity? Are those additive? We can stack those on top of each other? And are there rules of thumb associated with what those discounts look like?
Yeah. So let me answer the second question first, because it's easier. So the general rule of thumb, and I say this with some authority because I trained with the person who established the valuation review program within the IRS. So I've got some inside baseball. The IRS is much more likely to closely review your gift tax return if the combined minority and marketability discounts are over 40%. Now, that doesn't mean you'll never get audited under 40%, but the likelihood goes up significantly. And there are a couple of practitioners that have made a fantastic living by applying much more aggressive discounts that are not unsupported, by the way. There's a guy named Ashik Abbott that does a really good job of this. And he finds clients that are willing to go to war with the IRS, and he makes hundreds of thousands of dollars on these cases and as an expert witness because he takes and supports combined discounts of 60, 70, 80%. And he often wins, by the way. But not everybody says, you know what, I want to go to war with the IRS. I'm willing to put my name on that court case, and we're going to do this for 5 to 10 years. So as a rule of thumb, not that I calibrate to this, but to answer your question, the IRS is much less likely to challenge combined discounts under 40%. Now, the answer to your first question, which is the combination of liquidity and marketability discounts, there is a raging debate, and there has been for decades within the appraisal community over that exact same question. Arguments have been made that majority stakes and 100% stakes in companies are always marketable. I don't take that position, but that's the position that many people take. And so minority discounts are inherently non-marketable, and therefore any minority discount that you might compute or estimate inherently includes a discount for lack of marketability. I'm not sure that that's the case. I do think there's a differential of marketability between a controlling interest versus a non-controlling interest, but it's even under the best of circumstances, it's hard to sell a privately held, closely held company. It's hard to sell even a majority stake if it's a fractional interest in a company, and the market sort of reflects that. So I take the position that a minority discount and a marketability discount are often appropriate.
Do you take into account the number of shareholders or number of owners in a business for marketability?
Absolutely. Absolutely. I mean, that gets into the 1% versus the 49%.
Yep.
And also, by the way, what if your vote is a swing vote? Meaning that what if there are three shareholders? There's a 48% shareholder, and there is a 51% shareholder, and then I've got the remaining, they're 1%. I might be able to impact with my small share, I might be able to impact policy. And so all of a sudden that swing vote share becomes much more valuable share for share than it would on a minority basis. So yes, absolutely. And that's an extreme case. But the more shareholders there are, generally speaking, the greater the number of shareholders that there are, the less valuable a large share becomes, and the less of a penalty you necessarily get with a lower percentage, because you're sort of in the same boat as a lot of other people. So this is a classic case of where you have to understand the facts and circumstances of each case as it comes along.
Because we're seeing that now with a lot of these companies staying private longer. You have these huge private companies that have decent liquidity for private shares from employees. And the company can affect that as well, which I imagine has to be taken in. If the company allows buybacks from employees and some sort of liquidity, then would that also lead to more marketability or more liquidity there? Yes.
Well,
I find it fascinating that you could go into all of these different levels because it really does depend on the specific circumstance of the company and the company's policy. So I could change a policy for the company and add liquidity essentially even to a private company for shareholders, which would increase the value of all of the other owner shares.
yes. And one of the things that is often overlooked is that you can synthetically create any kind of security you want. And the implication of that is that people who do what I do have to kind of become amateur paralegals, because that means you have to read a lot of documents with dry and confusing and arcane legal language to understand exactly what those restrictions or lack thereof on transfer, how does that impact, how does it impact your discount for lack of control if there are drag along rights, meaning that if the seller sells and you have to sell along with the majority owner of the company, right? Or what happens if there are tag along rights, meaning that if somebody sells their shares, you're allowed to sell your shares, you have the right to sell your shares on the exact same terms. What if there's a right of first refusal, which is sort of an embedded short call that I think is properly valued using game theory. So these things can be very complex. And I think the really sharp estate attorneys are well aware of these levers that are out there that sort of combine contractual restrictions with financial theory to kind of optimize or kind of produce the discount that they want, not because they're manipulating the appraisal, but because they're creating the appropriate conditions that lead to the discount that they're trying to achieve.
That's exactly what I was wondering. It seems like there would be a lot more of opportunity for updates to the actual organization of a company that could drive this up and down, even before it gets to the appraisal perspective, right, when it comes
For
to
sure.
discounts and liquidity.
I mean, one thing I'm finding myself called upon to do more now is to consult with the client and the legal counsel on how to structure their agreement or their transfer agreement or their operating agreement in order to lead to the type of discount that they're hoping for. They'll say, hey, we're thinking about doing this. Run a model for me that shows how, if you were the appraiser, that would impact the discount. It's a practice I'm surprised I don't see more because I save millions of dollars of taxes for clients just by taking that additional step for fees that are a fraction of that.
And for, I guess, what from a mindset perspective, and we talked a little bit about the gifting and the estate considerations, but as we wrap up here today, when you're talking to founders or families thinking about valuation or one of these major events where, as you said, they're going to sell once and they're likely selling to someone who's bought multiple times, what is one mindset shift that you would encourage when it comes to valuation?
I think the mindset shift is to avoid thinking about fair value. I can't tell you how many times I've had clients come to me and they say, all I want is fair value. I say, oh, great. We'll do the assignment. And then we do the assignment and they get what I call a fair value face. Right? They see the report, they read it, they furrow their brow, they kind of crinkle their nose and frown. And then they want to know what unfair value is. Right. If you shoot for fair value, what you're doing is you're shooting for average, which is a bad negotiating tactic because you're starting from a perspective where your best case scenario means you do only average. But that's not how you prevail in a negotiation. You prevail in a negotiation by taking a strong position and then over time or over the course of the discussion, trading things away that's going to get to maybe a different value, but your hope is going to end up then better than what you would have accomplished with a statistical average. So I think getting out of the fair value mindset is really important.
It's a great way to wrap up that conversation. Why settle for average? So
Absolutely. I mean, yeah,
perfect.
you don't need my help to settle for average. On average, you're going to get that.
Well, Mike, thank you so much for being here today. Learned a lot. It's always an interesting discussion. Appreciate you coming on.
Well, thanks very much for having me.
That's our show. Thanks for listening, and we'll see you next week.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.